Hello and welcome back, Insane Friends. Today, this is not financial advice, and I'm not telling you what to do with your money, but I will share with you completely transparently what I'm doing to prepare for recession and why I think a recession is coming, what I have experienced in my lifetime that has to do with recession, interest rate hikes, and so let's get into it right away without any further ado. Now, when I was a kid, early kid in the early 70s, I didn't know much about recession or interest rates or inflation or any of that. My idea of economics was, Mommy, will you buy me that candy bar? Please buy me that candy bar. That was my whole understanding of economics. By the late 70s, I was knocking on doors, looking for work. I would try to sell things door to door, stuff like that. And I started getting an understanding of business and economics, that sort of thing. When I made money, I would take it to the grocery store and I would buy something for dinner. Sometimes my idea of buying something for dinner was to have a big chocolate pie for dinner, but then I was a kid. So please forgive me for my bad decision making when I was a kid. I was probably 8, 9 years old. Um, and even then, I started noticing that prices were getting higher. And the things that I would buy in the grocery store, or if I had food and I was still making money, then I would go to the candy store or the toy store or the five and dime, something like that, and splurge a little bit. Now, everything was getting higher and higher. We had some rampant inflation in the late 70s and the early 80s, and I was old enough to be aware of it and be aware of what was going on. So the Fed decided to, like they didn't announce stuff back then, as far as I know, about we're going to raise interest rates. We're going to raise interest rates. I think it was more of a hawkish thing of, look, this inflation is getting out of control. We're going to have to do something about it. We're going to raise interest rates. Bam, they raised interest rates. And right now, the Fed is talking about 4 interest rate hikes over the course of the year at 0.25% apiece that might add up to 1%. That was closer to 20% in the early 1980s that they raised the interest rates in order to get the inflation under control. So in my mind, my subconscious mind is screaming at my conscious mind, look, 1% ain't going to do it. It didn't do it in the past. It's probably not going to do it now. And of course, raising those interest rates helped bring on a recession back then. And just let me show you a little research I've been doing, because I don't just go by memory alone, because memory can be faulty, and it has been many decades since I experienced that. So I don't remember everything that was going on. Plus, I was not as old as I am now. I wasn't as wise. I wasn't as experienced. So I've done some research to go back and see, is this stuff that I'm remembering still correct? Is it relevant? Is it, close enough to what's going on now to make any kind of difference? And like I said, this is not financial advice. When I tell you what I'm doing with my investments and how I'm protecting my money or any of that, it's not any kind of suggestion. I don't want you to follow me and follow my financial moves, but just for entertainment purposes only, and for the purpose of transparency and honesty. I just letting you know what I'm doing. And if you're into investing or stocks or any of that like I am, then maybe you can put your comments below and let me know what your thoughts are on what's going on now, what you've lived through in the past, how these things are relevant, and we as a community can communicate and maybe make better decisions with information from each other. So moving on, what did I find while doing research? Well, first of all, there's the Fred recession chart. The Fred recession chart seems to be a wealth of knowledge here from looking at recessions of the past and how they correlate with inflation and rising interest rates. And there does seem to be a big correlation here. I'm seeing, well, you can go to the chart that goes all the way back to the 1950s, and you can see 1951. There is one where it took a couple of years before there was a recession, but that one seems to be the exception, not the rule. The rest of them here, you can see 1970, 1975, 1980, in the 1982 and 3, which that kind of felt like when I was living through it, one big long thing together, even though there's, according to the chart, there was a break of like a year in between. It didn't feel that way when you were living through it. And I never thought of it that way until I saw this chart. It never felt like there was any break in between. So I would just count that as one, not two. And then the late 1990s, of course, the 2008, 2009 thing. And then, well, I skipped one. There was 2001. Yeah, that's a whole nother video right there if we get into that. So, and then the 2000, that's 1, 2, 3, 4, if you count those two in the early 80s together. 1, 2, 3, 4, 5, 6 of them from 1970, all of which I lived through. So the thing back in 1951, I wasn't alive, and any more between there, and because I was born in 67. So these are the ones that I've lived through. Of course, I have no recollection of what was going on in 1970. I was too young. I was alive during that, but I didn't really experience it. And 1975, yeah, that was, I experienced that, but not to the extent that I did the one in the early 80s and the 90s and the 2000s, and again, the 2008, 9, which is kind of like in the 2010s, because that's how it started off that decade. And so we know that these things happen. We know that they were correlated with the inflation and the raising of interest rates. And to me, it was a necessary pain to have to raise those interest rates to get rid of that inflation. And I know there's more to it than that. I'm oversimplifying it. And you're welcome to comment about it and the other factors that were involved in the comments, because, yeah, that's very valid points if you want to make those points. But there was inflation and there was raising interest rates involved in those recessions. And we have those same negative catalysts right now. And a lot of people are arguing about, will we have a recession? Will we not have a recession? And this and that and the other. Well, I'm convinced that I need to position myself financially as if we're going to have a recession, because I'm convinced that there's going to be one. But don't handle your money on what I say, because I am not a financial professional and I'm not a financial advisor. I'm not qualified to give people advice about their money, and I wouldn't want to my mistakes that cost me money to cost anybody else money either. All right, so number one, doing some quick Google searches and stuff on why the interest rates go up in 1980. According to Google, the reason interest rates, which ultimately are set by the Federal Reserve, exploded in 1980 was housing's arch nemesis, runaway inflation. So it's not just me and my perception and my memories saying that there was runaway inflation, and that's why the interest rates exploded at that time, and that we did have a recession. I mean, it's documented facts. The cause was an inflationary spiral. Now, this isn't my words. It says right here, the cause was an inflationary spiral brought on by rising oil prices, government overspending, and rising wages. Does this sound familiar to what's going on right now? Okay. Next search in Google is, how high were interest rates in the 1980s? Well, according to Google, interest rates reached their highest point in modern history in 1981, when the annual average was 16.63%, according to the Freddie Mac data. Fixed rates declined from there, but they finished the decade around 10%. The 1980s were an expensive time to borrow money. Okay, I've seen some other conflicting data on this. And if you have some information on this about exactly what the interest rates were back then and what your source is, even if it's just your memory about you were borrowing money to get a house or whatever, please let us know in the comments, because this is this is good information right now to have if you're trying to plan out your financial situation for the next couple of years based on data from the past, trying to figure out what's going to happen in the near future. Please share that information, share your perspective. Let us know what you know about those situations back then and how you think they might pertain to what's going on now. Now, on Investopedia, I found this really good article about what causes a recession that I don't necessarily agree with everything in the article. So, these are not my words, but I do think that Vicky Velasquez, I want to give her a shout out for writing this article, does have some good points in here. And the article says by the Investopedia team. It was reviewed by Summer Anderson and fact-checked by Vicky Velasquez. So it wasn't written by Vicky Velasquez. I misspoke on that. Please don't quote me on that, but I misspoke. Vicky Velasquez did not write this article. It was written by the Investopedia team, reviewed by Summer Anderson, and fact-checked by Vicky Velasquez. But I believe they all should receive a shout-out. I'm not going to read the whole article. I'm going to go over some of the stuff in here. The National Bureau of Economic Research defines a recession as a significant decline in activity spread across the economy, lasting more than a few months, visible in industrial production, employment, real income, and wholesale retail trade. I just want to clarify on this, because I'm not saying that there's going to be a depression, or I'm not preparing for a depression. I hope that we don't have a depression. I'm not saying that we couldn't possibly have a depression. Like I said, I'm not an expert in this field, but I do think that from my past experience that we're going to have another recession. And I want to clarify what a recession is, what I'm claiming I think that we're going to have, and that I'm preparing for. A recession is also believed. Temper that with the thought that I can very easily be wrong. This could be another exception like 1951, where we don't have a recession until like a couple years later, and then you can debate on whether it was caused by whatever. Don't know. A recession is also believed to be signaled when businesses cease to expand. The GDP diminishes for 2 consecutive quarters and the unemployment rate rises. Okay, I don't think they mean that all businesses cease to expand, because I think if you were to go back in history and look at it that way and just nitpick, you'd find that there's got to be some businesses that expand during any period of time ever. You can find some exceptions to the rule that there are some businesses that are expanding And I don't want to say no matter what, because they might have expanded during a recession and not expanded in other times. But yeah, just I think they're mostly right about this. The recession is believed to be signaled when businesses cease to expand. So I would have worded that when most businesses cease to expand. The GDP diminishes for 2 consecutive quarters and the unemployment rate rises, which I think is coming. It hasn't happened yet. Then I think it probably come after the interest rates are rising and after the Fed starts selling off some of the bonds that they've been buying. The nature and causes of recessions are simultaneously evident and uncertain. Recessions are, in essence, a cluster of business failures being realized simultaneously. Firms are forced to reallocate resources, scale back production, limit losses, and usually lay off employees. Those are the clear and visible causes of recessions. There are several different ways to explain what causes a general cluster of business failures, why they are suddenly realized simultaneously, and how they can be avoided. Economists disagree about the answers to these questions, and several different theories have been offered. Microeconomic and microeconomic signs of a recession. The standard microeconomic definition of a recession is 2 consecutive quarters of negative GDP growth. When this occurs, private businesses often scale back production and tries to limit exposure to systematic risk. Measurable levels of spending and investments are likely to drop, and a natural downward pressure on prices may occur as aggregate demand slumps. GDP declines and unemployment rates rise because companies lay off workers to reduce costs. Now, do you see any signs right now that this might happen? Or do you see this happening in some of the companies already? Please comment below. At a microeconomic level, firms experience declining margins during a recession. When revenue, whether from sales or investment, declines, firms look to cut their least efficient activities. For example, a firm might stop producing low margin products or reduce employee compensation. It might also renegotiate with creditors to obtain temporary interest relief. Unfortunately, declining margins may force businesses to fire less productive employees. And that happens even more if you have a higher minimum wage. So that's why there's such a big debate over whether a minimum wage is good for low wage employees or not. Because if in boom times, it may be better for low wage employees than during recessionary times or stagnant times, because people just they'll be in a situation where instead of having a higher wage, they'll have no job at all, is the argument. I'm not going to argue either way here. You're welcome to discuss in the comments. General causes of recessions. The significant economic theories of recession focuses on financial, psychological, and fundamental economic factors that can lead to the cascade of business failures that constitute a recession. Whew! Okay. Somebody get out the thesaurus. Wow. Some theories look at long-term economic trends that lay the groundwork for a recession in the years leading up to it. Some look at only the immediate visible factors that appear on the onset of recession. Many or all of these various factors may be at play at any given recession. You think any of that applies to right now, or which one of those or both? Financial factors can contribute to an economy's fall in a recession. During 2008, 2007, 2008 U.S. financial crisis. I'm just going to interject here that I think that was the contributing factors right then are sufficiently different to the contributing factors right now. Is one of the reasons why I went back to, in my memory of my experiences, the late 70s and early 80s, to get away from the non-aligned factors between the 2007-8 financial crisis and the non-aligned factors of the 2001. Anyway, they say in the article here, the overextension of credit and debt on risky loans and marginal borrowers can lead to an enormous buildup of risk in the financial sector. The expansion of the supply of money and credit in the economy by the Federal Reserve and the banking sector can drive this process to extremes, stimulating risky asset price bubbles. Artificially suppressed interest rates during the boom times leading up to a recession can distort the structure of relationships among business and consumers. It happens by making business projects, investments, and consumption decisions that are interest rate sensitive, such as the decision to buy a bigger house or launch a risky long-term business expansion, appear to be much more appealing than they ought to be. The failure of these decisions when rates rise to reflect reality constitutes a major component of the rash of business failures that make up recession. So one of the things that reminds me of is that if you're thinking about investing in companies and stuff, you can kind of see this if you're looking at company financials before buying stocks, if they're, for lack of a better word, overextended. Right now, I am much less likely, well, actually, I'm just not, and this is not financial advice, I am not putting any money into the stock of any company that has a lot of debt and no profit coming in. They're having to burn cash to expand. And even companies like Tesla no longer are profitless. They have profit coming in. They have been in the near past paying off a lot of debts and hoarding cash. They've been building up a lot of cash. So other companies that are in a situation like that seem a lot more enticing to me in times like this than somebody that has factors that look like they might 2 or even 3x their stock price, but they have debt, but they have no profit right now. They may have a bulletproof, wonderful plan to profitability, but they're not profitable right now, and we probably going into a recession. I don't want to be involved in that. And I'm not suggesting you make your financial decisions based on what I'm doing, but that's my thoughts for doing with my money, is to go to the safer bets or just hoard the cash. Because I don't think we're at the bottom of the market right now either. Psychological factors of recession. Okay, I said I wasn't going to read this whole article, and I'm not. I think we've hit enough stuff here. You know, it goes on to say economic factors of a recession, impact of COVID-19 pandemic on the economy, and then they pitch about hiring a pro for help you with your stuff. All right, which I don't blame them for that. You know, they got to have some kind of sales pitch to make money, or they can't make these articles, keep the website up, all that kind of stuff. Let's not get overly critical about other people's ways of monetizing their stuff now. Let's not get critical of that at all. We should all be doing that in some way, shape, or form, as long as it's a win-win beneficial thing that we're pitching. All right. Again, Investopedia, if you want to read the entire article, beef up your information, beef up your brain so you can make better investing decisions. And let's see. And with that, I'm going to bid you adieu and wish you all insane growth and an insane amount of success. I'm Victor Sane. Thank you, and have a great rest of your weekend. Be careful with your money right now.